please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Okay, so the expected has happened. The indices are all in the red. The Nifty got there. It's flirting with the red now. It's not a great deal. It's all in flat terrain. But if you had bought in the morning, you're sitting on losses, and that's always negative for generally the bullish trend in the market. So, you could see people more people coming in and throwing in their long positions, as it were. And there could be a trending lower market today, something which our technical experts warned, and as did Anuj Singhal as well. Only the mid-cap index is standing in flat terrain and a little bit in the green at this point in time. But there is a lot of green in one part of the market, and those are the hotel stocks. We have seen them suddenly go from strength to strength, and so today we decided to invite two people who would know about hotel stocks with greater detail. We are joined by Vishal Kamath, the director, Kamath Group, and Vikramjit Singh, who is President, Lemon Tree Hotels, to understand what's going on. Let me start with you, Vikramjit. Okay, all right, we should get Vikramjit in a minute. Unlucky with telephone lines. Vishal Kamath, what is your sense about room occupancies? How has it moved vis-a-vis last quarter in April? And how is it doing, say, from year ago levels?
Happy Akshaya Tritiya to you, and it's been very good for the hospitality industry as a whole. I think what we are seeing in the market right now for the hospitality stocks is not really related directly to the occupancies or the ARRs, because I have been saying from last 2 years that it's been improving, and those people who have been tracking this sector, they have been seeing this. It's only that now it has come to the fore for the masses. But those who have taken the effort to study our sector over the last 2 years have seen this upward trend, which will continue because hospitality is booming. What we actually see in the market is that I'm glad that you have Lemon Tree here with Vikramjit Singh, because what they've been able to do with their successful IPO is now, after a long time, the hospitality industry has got a benchmark, and that benchmark is making investors, shareholders relook at what company valuation should be for hospitality based on the turnover, the EBITDA, based on various other factors. So what you see in the hospitality is basically a correction of the already underlying value, which has been low, but the real potential is high, and Lemon Tree's proved that to the market and to investors. Sure. So what we see, even though other people are doing well or not well, our industry is going to boom.
Okay. So when you say going to boom, Vishal, good morning. What kind of growth are you looking at over the next 1 to 2 years for your own business? Yeah. And in terms of room addition as well, what can we expect?
See, we are obviously looking at where we already are. Like I've said before also on your channel, wherever we already are, we are looking at expanding our capacities where we can. It's not, it doesn't make business sense today to go in for green fields with long gestations. So if there is incremental business we can grow by adding room capacity, like we are doing in some of our hotels, like in Orissa and other places, and where there are certain brownfield project opportunities where the gestation is very short, those especially are the ones which we are looking at, and in terms of our expansion plan. More importantly is that occupancies have been already high last year, but it's even more better this year. I mean, last year in the month of April till now we had only some 75-78% occupancy for the month till now. But this year we're already sitting in the high 90s. And I think this trend will continue, which in the monsoon normally, where we expect the city average to be for the city of Mumbai in the 60s to 70s. We feel that this time it will be much better than last year, because companies are spending. See, hospitality can only provide to your needs, and the needs of our consumers have gone up. People are doing more conferences, more events, they're doing more sales meets, and we are taking advantage of that.
Okay. Well, Vikramjit, the telecom line with you is off and on, but I don't know if you heard the lavish praise that Vishal Kamath showered on you and your IPO. Vishal said that Lemon Tree's valuations have become a benchmark.
Well, like you said, off and on I have.
Okay. Well, anyway, he's been saying that...
Thank you, Vishal, and I look forward to meeting you sometime soon.
Okay. Well, this is an on-air meeting. But Vikramjit, what's your sense? Vishal has also been speaking very positively about occupancies. What's been the trend in Lemon Tree? Is the year-on-year number far better? Is the quarter-on-quarter number better? Can you give us some trends?
So, for me to answer that, I want to give you a little bit of the background of our industry and where it is. So between the years 2009 onwards till about 2015, we witnessed the longest bottom of cycle conditions. And when I say bottom of cycle, I mean the average India occupancy was way below 60%. At this time, what happens is that the supply was far greater than demand. To give you a flavor, what happened was that during this period, supply grew at about 14% CAGR and demand was roughly about 12.5%. So therefore, what resulted in was low occupancies and probably the lowest we've seen in the longest time ever. Like I said, this was the longest bottom of cycle. But over the last couple of fiscals, corrections happened. So to give you a flavor, 2016, the average India occupancy was 63%, which grew further to 65%. And I want to make a statement that going forward, as per Harvard HTL, supply is going to shrink to about 7.9%, and demand will continue to grow at 12.4%. So what this means, and this is projected till the year 2021. So what this means is that going forward, we will have absolute top of cycle conditions for the industry. And the good days are not only here, but they are here to stay for a while.
But the industry has gone through a dramatic change over the last many years as well, right, Vikramjit, with Airbnb taking over a lot of the market share. Of course, this is in the big metros, and not only Airbnb in the mid-price segment, we're also seeing the likes of Oyo, Ginger, etc. How do you deal with competition, and have you been sort of changing your strategy to adapt to that?
So I'll tell you, Lemon Tree today operates about 4,900 rooms across 48 hotels in 30 cities. And I would say we are more in the economy, mid-price and the upper mid-scale hotel. If you talk about the likes of Oyo, Ginger, I think they operate a level below our economy brand, which is Red Fox. So therefore, we do not face any competition from them. We've not seen any challenges arise with the accumulation of inventory, the aggregation of inventory that these guys have done. As far as Airbnb is concerned, I think it's still a long way to go. But just to tell you what we are looking at and how we are growing, today in the development pipeline, we've got about 3,100 rooms more to come up across 27 hotels in 22 cities. So by the year 2021, our count, presuming we add not a single room from today, which is absolutely unlikely, we will be about 8,000 rooms across 75 hotels in 52 cities. So we have a very robust development pipeline, and I think these numbers are only going to grow from here.
Okay. So what would a likely EBITDA trajectory look like, EBITDA growth? Would it be 15, 20%?
See, I don't want to comment on numbers, but what I can tell you is that Lemon Tree, to give you some of our numbers, we finished the fiscal of 2017 at an occupancy of 76.8%, which against the India average as per Harvard HTL was 65%. So we already command a huge occupancy premium over the market. Going forward, we've already shown some price hike, and this number will only grow up. We're going to be hardening prices even further. I think that is already being seen across the industry, but it's going to go up. So without commenting on EBITDA numbers, absolute numbers, what I can tell you is that with such high occupancies and we're looking at taking our prices up, it's going to be very healthy numbers. Okay.
Vishal, the problem that...
So positive times are here ahead.
Sure, and that point is very well established by both of you. But Vishal, the problem that your hotels have had is that it's been loss-making for the last many years. Of course, the good part is in FY17 and first half of FY18, you've sort of moved into the black. But are you undertaking more cost-cutting efforts, and where do you think there is potential to reduce costs now to increase profitability?
See, I want to add to what Vikram has said. Let's understand, when you asked about Airbnb and Oyo, that's a very important point to raise. First and foremostly, they are not adding any new inventory. All that is happening is a reshuffling of the deck of cards, but the cards are 52. They are taking existing hotels and rebranding them, and that's a model that's working for their market segment. Our country is huge, and the business potential is so huge that even after multiple players coming and reorganizing the market, the volume is still there. So it's not a problem of supply and demand, which was the case in the last 5 years. It's basically a reorganization of organized market getting structured into whether it's Oyo or Tribo or Fab Hotels. All these are fantastic products. The hospitality segment has moved towards a more organized market without adding inventory. Today, it is not viable to make new hotels in certain markets because the land cost, the development cost is not affordable. The ROI doesn't justify. Yes, someone may make it for, as part of a chain or as part of a fancy that I want it in this city. But at the end of the day, whether the ROI is justified, it won't. That is basically where there's a natural insulation to hospitality as a market, like say Mumbai or Delhi or few other cities, where new supply will come very less. And that is where the consumer in India, unfortunately, or rather fortunate for the consumer, has been very pampered with higher superior products at a lower price because of the mismatch in the demand and supply. That is getting corrected. Today you find fantastic hotels giving dirt cheap prices for the kind of quality offering that they're giving, but they had no choice. But now they do, and it's going to be a win-win scenario where they can continue to give that quality at a price which they can sustain, and the consumer also will pay for something which is worth that price.
Oh, right. Point taken. It's two different sectors. Vikramjit and Vishal, thank you very much for joining us and giving us a flavor of the hospitality sector and why the shares are moving up.
Oh yes, they are for last many days now. But the market is now static after that initial downtick, now consolidating at around 10,555 on the Nifty and about 25,314, 315 on the Bank Nifty. The mid caps have done well today. Advance decline in favor of advances, at least for now. Ashwini is back with us, so is Mitesh and Sandeep Wagle in our studios. Ashwini, we discussed the index calls. What about individual stock calls at this point?
See, on futures, mid-cap IT is doing well. So Hexaware is a buy with a stop of 415, target of 440. BPCL is a sell with a stop of 412, target of 395. ICICI Bank is still a sell with a stop of 295, target of 282. We're trying to hang on to 10,550. Let's see if that can work. My sense is that the bounce is fairly weak and maybe at some point we'll decisively go below.
Okay, Mitesh Thakkar, Sandeep Wagle are also here with us. So let's get some thoughts out from them. Mitesh, what are you doing now? Absolutely flat for the market, but any interesting stocks?
For the timing, we've sold Nifty call options, but we are looking at some stocks on the long side. I think Ultratech Cement, the intraday charts have given a very strong buy here. So keep a stop at 39.20, look for a 40.50 kind of a target. The other one which I like is Marico. It's a conditional buy. Let it get past levels of 324 and then buy. Keep a stop at about levels of 318 then and look for 334, 335 as your target.
Okay. Before I get to Sandeep, I wanted to ask one of you, any of you, Nalco. It's up 2% and it's obviously been a very well-performing stock. There is a trade there, Mitesh?
Nalco, I think, Lata, we've recommended a few days back, I think, when the entire price movement started, and I was looking at target close to about 82 to begin with, 82 to 83 and then possibly even 86. So not the best time to enter a trade, but if somebody is holding it, revise your stop loss to about 76.80 and look for targets close to about 83.
Okay. Sandeep, your good morning to you. Your stocks today?
Good morning, Lata. I would go with the buy in a Hexaware as well, a clear breakout. Buy it with a stop loss of 418, target 438. And my second call would be a buy in a DHFL, stop loss of 593, target of 618.
Okay, well,
Ashwini, finally, Yes Bank, is there a trade today?
Most of the private banks are lower.
Okay.
I don't think I want to buy into it, but it's doing a bit better than the others.
Yep.
So maybe avoid Yes Bank for the day and focus on the other stocks which are weak, like Kotak or ICICI.
Sure.
okay, well, let's do one thing. Let's take a short break on that note. It's absolutely flat for the index, but plenty of stocks to talk about. An exclusive interaction lined up with Matthew Job, the CEO of Crompton Greaves Consumer Electricals, on the other side of the break, so don't go anywhere. At this point in time, the market is absolutely quiet, so not doing too much, but there are plenty of stocks that are looking pretty good. As we told you, Titan is just short of the 1,000 rupee mark this morning, so just keep an eye out on that. And a whole host of other stocks are in fact hitting new highs today, so whether it's a lot of these FMCG names, that have come back on the radar, Nestle, Pidilite. By the way, way, Taj GVK, we've just had that hotel discussion. Taj GVK is now up almost 12% and big volumes traded on Taj GVK this morning. VIP, Divi's Labs, Mindtree, Pidilite are just a couple of other stocks that have been doing exceptionally well lately. And today as well, these are stocks moving up. So mid-cap IT is really the flavor of the day. Hexaware, Mindtree, etc. are all up in the green right now. But the Bank Nifty is the only one that's slightly under pressure. Nothing really to worry about. I mean, it's flat with a bit of a negative bias, but some pressure coming in from, the likes of Kotak Mahindra Bank, Axis Bank, slightly in the red at this point in time. But it's Akshaya Tritiya today, and it is the biggest gold buying festival in India, as we know. Manisha Gupta joins in now. Manisha, sky-high prices for gold this morning. But what's the initial feedback that you're getting? Are a lot of people buying gold today?
Well, they are, yes, Sonia. And, it's also coinciding with the wedding season. So the wedding jewelry booking also is happening. And even as the prices have been higher, the ground report that we are getting in right now is that the bookings for jewelry had begun 2 or 3 days prior itself. And it is the delivery that most of these people will be taking in today. So as I've been telling you, there have been various offers, discounts, making charges being waived off. That is something that is also that the customers are making use of. Important thing also is that the Indian markets have seen gold being sold at a discount, because remember, the Indian jewelers and traders have bought gold on a lower level, and since then we have seen a lot of volatility and price rise in case of gold prices. So they actually are passing in on that profit also to the customers. This also is yet another way of attracting customers. So we are looking at around $2 to $3 of a discount that the Indian prices are selling at in sense of the international market. So yes, it is what we are seeing reflecting into prices as well, still holding above 31,000. But remember, that is the calculated price. When you buy it in the markets, it also has the GST, the 10% import duty, all of that added into the prices. So that at this point in time is working out to be plus 32,000 in the spot markets, and silver as well is trading at 40,000 rupees per kg in the spot markets there. This is, of course, the future market trends that we are seeing mirroring the international markets right now. But it has been good going for the industrial commodities. So if you look at the crude oil prices, we have opened on a positive note. It is trading 0.5% in the global markets, and that's exactly what we are doing in the Indian space as well. A percentage point up on your screens there. It has to do with the decline in the US weekly inventories, the decline in supplies from Venezuela, and of course the geopolitical concerns also applying to supplies there. All of that is working its way in case of prices. The industrial metal prices also have opened on a higher note. If you look at aluminum, that is trading 18% up in this month right now. We are at a 3-month highs and very close to a 6-year highs as well for aluminum prices. The other metals that have done well, of course, has been the steel ingredient nickel. That's because the Shanghai markets are trading positive, and that seems to be trickling down for the Indian markets as well. Trading strategies, and we have that for Kedia Commodities, and they choose to be in for energy sector today. A buy call coming in for crude oil and natural gas coming in from them for the day today.
Okay, thank you very much for that, Manisha, and I'm sure you have a busy day ahead with gold and Akshaya Tritiya. But we'll just move back into equities for a bit. We have an important stock on our radar, and that's Crompton. Anisha Jain, our colleague, caught up with Matthew Job, the CEO of Crompton Greaves Consumer Electricals, and she began by asking him when he sees the company's growth coming back to the old 15 to 18% mark. Listening to a slice of her conversation.
In the last 10 quarters, with the exception of the DeMon and the GST quarter, our estimate is that the market has grown 6 to 8%. Okay. And our growth in all the quarters we have declared results so far has been roughly 11 to 12%. So obviously we have been growing at anywhere between 1.5x to 2 times the market. Of course, you're right. The market in the last couple of years have grown slower than the best years, and primarily because of the real estate has been depressed comparatively. Right. It's very difficult to predict when real estate will really come back to the levels we have seen about 7-8 years ago or 10 years ago. But we remain optimistic that it will happen in the future. And of course, what growth we can achieve in terms of revenue growth all depends on how much the market is really going to accelerate. That's one of the reasons why we have linked our objective to outpacing the market rather than put an absolute number. Because it's very difficult for us to control the market growth. What we can control is what we do. And of course, the eventual numbers will be a combination of 2 things. How much the market is growing, and how much our programs and the way we execute our programs allow us to outperform the market.
Okay, so you can't predict the growth in real estate, but what the Met Department has done has predicted the monsoons in summer for us. So summer is expected to be harsher. What is the expectation of fan sale then? And other than that, what is the expectation of pump sale given the monsoon prediction is normal? What would be the sales as far as pumps is concerned?
I think, of course, you're right. The Met Department has predicted a hotter than usual summer.
Right.
And of course, that of course normally would bode well for coolers and would bode well for fans. But I think finally it's a combination of a host of factors. Some like housing growth, which have not been on a very high. Obviously, if the summer is as harsh as it is predicted to be, that will obviously be good for the industry. But also we need to keep in mind that a few parts of the country have been facing unseasonal rains. So of course that has a not so positive impact. I think the real story will only be known at the end of the quarter, but we remain optimistic as always.
Okay, so remain optimistic as always. Is that the case for margins as well? Because 13% has been where we have been for a while, but the commodity prices, whether it's copper or aluminium, have been really on the flip side and posing some headwinds. What's your assessment for EBITDA margins going forward?
See, if you see, just like we said, we want to grow our revenues faster than the market. Our objective on profits have been to grow at least in line with sales. But if you look for the period, the last 2.5 years, where we have declared results, our margins and our profits have grown significantly faster than sales. It has happened because of a host of factors. One, the strong cost reduction programs which we have driven, which have I think yielded outstanding results. Second is in terms of driving the mix, the fact that, for example, we have improved our mix from 7% in premium to 20%, and similarly in LED lighting, similarly also in pumps, have also helped us drive strong profitability. I think a host of these programs are not one-off. The programs will continue. We continue to drive cost reduction aggressively.
So, Mr. Job, a couple of points that the analysts mentioned is that the markets like fan and pumps have reached a mature level, and you'll have to come out with a lot more new products and maybe some new things regarding the cost efficiency as well, because as per them, the margin scope of improvement is very limited. Is that something that you share as well?
See, I think it's got to be a combination of a few things. One is, of course, innovation. Of course, I think if you look at just the example which I gave some time back in terms of premium fans, how they have grown. They have grown because we brought a strong innovation to the market. 2 years back, we said we want to grow premium fans from 7% contribution to 15%. Such has been the success, it's become 20%. So mix improvement. See, I said some time back also that anti-dust fans has not run its full steam. There's still opportunity. The Air 360 we are launching, we think we'll be able to drive the mix to more standard fans, from eco and sub-eco, more to more standard fans. I think so. There's a lot of opportunity for that innovation can continue to drive mix improvement. Cost reduction efforts, I think, are not a one-off. We continue to drive that cost reduction very strongly. And of course, I think the commodities cycles are beyond our control. But I think what we can control is a few things. One, continue to drive cost reduction aggressively. Continue to bring innovations to market so that our mix can continue to improve over time. And of course, a part of it will also have to be passed on to the consumers in terms of higher price. I think a combination of these three has helped us to drive our profitability in the last few quarters. And I think what has worked and continue to work in the future. I think we remain very confident.
Okay, remain very confident. That actually, a lot of important takeaways coming in over there, especially, the way the lighting segment, the growth that we've seen over there. As he said, the market share improving. Fans, of course, they've been doing very well. We'll take a short break on that note, but on the other side of the break, we will speak about the pharma.